Welcome, everybody. This is Eric Hayden with Urban Catalyst. We're going to get started. We have a really great turnout. I'm here today with CPA expert Nick Gibbons from Armanino, and we're going to go through opportunity zones and tax and everything we want to talk about. So, as I mentioned, I'm Eric Hayden. I'm the founder of Urban Catalyst. We are an opportunity zone fund focused on ground-up development projects in downtown San Jose. Of course, we have some disclaimers that we have in front of all of our slide decks, and if anybody's interested in reading in more detail, everybody can come back to this slide at a later time. As far as our agenda, I'm going to introduce Nick, then we're going to talk about the different types of eligible gains that can be invested into a qualified opportunity zone fund. We're also going to go through the Urban Catalyst Opportunity Zone Fund and really what our timeline is. Obviously when we raise money, when we're planning on distributing income back to our investors and profits. In December, the final regulations for Opportunity Zone funds, the Treasury and the IRS came out with those regulations. It was the third round, and they had some pretty awesome benefits that Nick is going to talk about. We're pretty happy to have Nick here to go through all of that with us. Next, after that, we're going to talk about SEC accredited investors, really what that means and what you have to do to be accredited. And that's, of course, to invest into a fund like Urban Catalyst. And then finally, the nuts and bolts of how do you actually report your investment into an opportunity zone fund on your taxes. I guess this is the last thing, which is why San Jose. Urban Catalyst is in San Jose. Why are we here? Nick is from San Jose, of course, works here in downtown San Jose. And we're going to talk about how awesome San Jose is. So to get started, talk a little bit about Urban Catalyst. I want to give you guys a brief overview of Urban Catalyst to get started because, we'll talk about Urban Catalyst, but want to get to the meat of everything, which is Nick and his expert presentation. So I started Urban Catalyst with Josh Burrows in August of 2018. Really, we saw a change in the downtown San Jose real estate market, really the light switch turning on here in downtown. And we wanted to be a part of it. We wanted to acquire property, really get in on the ground floor. Josh, of course, prior to working at Urban Catalyst, worked at Barry Swenson Builder. He managed their downtown portfolio for 12 years and really is the expert in downtown San Jose when it comes to real estate development, property owners, and just overall how downtown operates. Really our goal when we built this team was to put a team together that is the best team for downtown San Jose, for downtown development right now. Next, we brought on Morgan Mackles. Morgan is one of the partners, and he is the head of investor relations. Morgan and I were friends in high school, and he has worked for a series of successful startup companies, building their sales teams. He builds scalable and repeatable processes. Next, I want to talk about Sean Raft. Sean is an attorney by trade, but has graduated from being an attorney like all good attorneys do. Sean runs a family office, and we brought Sean in to really do all of our administrative work. He is just an expert when it comes to tax, accounting, all of the compliance issues that we face with the SEC and FINRA, how we qualify as an opportunity zone. He really is the guy that dots the I's and crosses the T's and makes me feel comfortable with our team and with our fund. Paul Ring, another amazing downtown developer. He worked for 15 years at the Core Company, specializing in ground-up projects, institutional grade here in the downtown area. And I've done 2 projects with Paul in my career, around 500 residential units. And Paul is just, he is built to manage and operate development and construction teams, and that's what he does here at Urban Catalyst. As a team, our experience in Silicon Valley, we've acquired almost $6 billion worth of property in Santa Clara County. We've also developed almost $5 billion worth of property. And you can see the heavy concentration of properties that we've developed in the downtown San Jose area. really making us the experts of that type of development. And when we do ground up development projects, we are always looking to see three things. And this is, anywhere, but San Jose has all three. The first is a demand driver. We need something that creates a demand for all of the different types of projects that we're building. And the Silicon Valley job engine, that is what creates the demand for our projects. Next, we want to see transit and physical infrastructure already in place. Many of you have heard about BART coming to San Jose and connecting to Diridon Station. BART is fully funded and scheduled to be operational all the way through downtown by 2030. San Jose State University is right in the heart of downtown San Jose. San Jose State has 35,000 students and 10,000 faculty members, making it the second largest university in the Bay Area behind Cal Berkeley. Little known fact about San Jose State is that San Jose State produces, or Apple and Google hire more engineers from San Jose State than any other university in the country. Norman Mineta International Airport, it's the fastest growing airport of any major city in America. San Jose did $1 billion remodel to it around 10 years ago, and it's really paid off for the city. And then the redevelopment agencies of California, when they were in existence for around 50 years, put almost $3 billion into the downtown specifically. And what they did is they built new roads and sidewalks and street trees. They improved facades. They subsidized different types of development, building parking garages. But what we really like what they did was they upsized the infrastructure. So when I build a building and I connect into the sewer or I connect into the water line, those water lines and sewers are already upsized and upgraded to handle the type of development that I'm doing. So you don't see me building, sewage treatment capacity somewhere because nobody had the foresight for the type of development that's going to occur here in downtown. Finally, and most importantly, what we really want to see in downtown San Jose from a development perspective is we want to see a local government that is pro-development. And I can't say this enough. In the state of California, it is a real challenge going from your initial planning application through building permit. And what they've done in downtown San Jose, because of the local leaders, politicians, and staff members, is they've really streamlined that process. In the rest of California, it can take 3 to 4 years to go through from planning application to building permit. Here in San Jose, you can do it, in 12 to 18 months. A great example of that is Josh, my partner. Prior to coming to Urban Catalyst, he worked on the graduate student housing high-rise, and he was the lead development manager on that project. And from the day he submitted his initial planning application to the day he pulled his building permits was 11 months. And San Jose has done that by really creating a way to streamline the entitlement process through the California Environmental Quality Act and through putting a general plan designation of downtown onto every property, really making the zoning process not as challenging. And what that means is every project that goes through in downtown San Jose, you don't have to go to planning commission and you don't have to go to city council for approval. You're able to have your project approved at the planning staff level at a planning director's hearing. So it's still a public hearing, but it's more of a, now this project approved, now this project approved. So significantly less risk. But now the man of the hour, Nick Gibbons. Nick is a friend of mine. Armanino does the tax work for all Urban Catalyst related entities. Nick is a CPA and is a true expert in the opportunity zone legislation. And he's really the reason why everybody's tuning in today. We're here in tax season, and it's great to hear from somebody that is a real professional in this type of work to understand really what we're up to here at Urban Catalyst and other opportunity zone funds. So Nick, I'm going to let Nick talk about some of the work that Armanino does and about himself a little bit.
Thanks, Eric. My name's Nick Gibbons. As Eric said, I'm a CPA. I work at Armanino. I'm a tax director. Been in the business for about 17 years. Worked at PricewaterhouseCoopers in San Francisco for around 9. Was in industry or outside of industry. at a company for a few years and then back into public accounting. I've been with Armanino for the last 5 years. My main sort of experience has been with C Corp taxation, but when the Opportunity Zone legislation came out, I got excited about it because it is the most amazing benefit in the history of the Internal Revenue Code. It's akin to a 401k and a Roth IRA. Basically, the IRS, the government allows for an investor to invest pre-tax dollars into a fund, and as that appreciation, as that fund, as that investment grows, once you exit that investment, you don't have to pay tax on it. It's an incredible piece of legislation. It's an incredible opportunity. So let's talk about how you can obtain benefit from this program. So first of all, an eligible investment has to come from a capital gain.
Yeah, and let me jump in here, Nick. I mean, we really look at opportunity zone funds and what is a type of eligible investment. And as you said, capital gains is what gets that preferential tax treatment.
Right. You can't just write a check for $1 million to Urban Catalyst, although I'm sure they would take it, and then reap the benefits. So you have to, this whole program began because of trillions of dollars of unrealized capital gains that are just sitting outside, and the government wants to bring that wealth into census tracts that need it. That's sort of the idea. So everyone wins. So you need an eligible gain. So what's that? It's a capital gain. So it's a sale of stock, sale of a business, or of real estate. Let's do a quick example, Eric. So
sure. So here at Urban Catalyst, because we're in Silicon Valley, 70% of our investors, their capital gains event was the sale of stock.
Right. Mm-hmm. So if you were in the money, let's say like $1 million in Apple stock, you could basically sell that. Let's say you're doing that this year in 19. You have $1 million of unrealized appreciation in Apple stock. So you put the trade in, you get your $1 million. You would then have, and there's a series of rules, but you then have a period of time to identify a qualified opportunity fund, such as Urban Catalyst, and you would transfer that money over to Urban Catalyst, and that's when it all starts then. So, and as that investment grows over time, that appreciation, assuming you hold on for 10 years, is all tax free. So for the federal rate, that's 23.8% tax free. Now, the original capital gain, I don't know if we want to get in the weeds here, Eric.
No, I think we're going to get in the weeds in a lot of detail in our next couple of slides. So let's just go on and kind of go through the highlight of the overview of really the three major tax benefits associated with the Opportunity Zone Fund. And I'll go through these just really briefly because I know you're going to really dig into it here in a minute.
Right.
So if you invest into a qualified Opportunity Zone Fund within 180 days of a capital gains event, the first thing you get is you don't have to pay capital gains taxes for 6 years. So that really means when you're filing your taxes in 2027 and paying those taxes.
Right.
So you get a 6-year deferral. Deferrals are great. Everybody likes deferrals.
Time value of money.
The next thing you get is when you pay your taxes in 2027, you get a 10% reduction. So for every $100 that you owed in taxes, you only owe $90. So
basis step up, technically.
Thank you for saying that. That's exactly what that is. And then finally, again, the third benefit, which I think is the greatest benefit, is that after your money seasons in an Opportunity Zone Fund for 10 years, all the profits from the fund itself are tax-free.
I like that, seasons. Yeah, as it grows. And when you exit, it's tax-free. It's incredible.
And of course, this is from a federal capital gains perspective. The state of California does not conform with the federal program. So you still have to pay your California state taxes, but still, as you mentioned, deferring that federal tax, getting a reduction and not paying any federal taxes from profits. That's a pretty big deal.
But it should be noted that initial capital gain, you will need to pay tax on that capital gain. Let's just be clear here. So the appreciation is tax-free. on the invested gains, on that $1 million example of Apple stock, 6 years from now, you will have to pay tax on that. However, you get a 10% basis step up. So you're paying capital gains tax on 900,000, right?
Gotcha. Cool. So I'll run you through our timeline a little bit of how things work here at Urban Catalyst. We're raising money in 2019 and 2020. We have 7 projects in our portfolio. We plan to develop those projects, of course, lease them up, stabilize them. And as we do that, we're going to refinance the projects. We're going to get takeout loans to pay off our construction loans. And a great part of the April guidelines that came out from the Treasury and the IRS, and by the way, for everybody out there, when the program was initially written in the Tax Cuts and Jobs Act of 2017, the Treasury and the IRS announced they'd be coming out with 3 rounds of clarifications. The first one came out in August of 2018. Sorry, September 2000. October. Oh, I know, I was thinking about it back then. October of 2018. The second one, April of 2019. And then the final regulations came out in December of 2020.
Week before Christmas.
Right. Sorry, December of 2019.
Right.
What we think was one of the most important things about the April guidelines was that it made it very clear that as a partnership, we are able to, when we refinance our projects, distribute those excess refinance proceeds to our investors. And really that means we're going to stabilize our building, lease it up, we'll go out to get that takeout loan, pay off the construction loan, and any excess proceeds go to our investor.
Right. So you get your money back early.
And that's a big
because
deal.
of the structure. I mean, you guys saw, with our help, that in order to structure most effectively a qualified opportunity fund is this 2-tier structure. So you got the fund at the top, and then at the bottom you have a partnership, qualified opportunities on business. But okay, sorry, keep going here.
No, it's okay. We love your insight into how, kind of technical details of how all of this work. Finally, after 10 years, after the money is seasoned in the fund, we plan to liquidate all of our assets one at a time. And that's really when we distribute the majority of the profits to our investors. And what does that mean? That means this is my example, if you initially invested in 2019 and 2020, your targeted refinance timeline is 2021 through 2025, when all 7 of our projects will stabilize and be refinanced. After that, we're more of a core fund. And you can kind of think of the Opportunity Zone program. For the first 5 years, we're a value add fund. For the second 5 years, we're a core fund. We have income producing properties. After we pay our debt service, we will have profits to distribute to our investors from 2025 through 2029. An interesting part of the program that I know you're going to dive into here that came out as a part of the December guidelines is the depreciation and the recapture of depreciation. And also, just to finish off my slide here, we're targeting selling all of our projects after the 10-year timeline.
And that's smart. That's smart, because this program goes to 2047, but it sunsets then, right? So there might be a rush in 2047 to sell all these opportunities on investments. So because you guys have organized and selling off in 10 years from invest 2030 or 2031 or whenever it is, specifically, that's key. That's smart.
Yeah, and that was definitely, we took that into consideration when we formed this fund. I thank you for pointing that out.
And I just want to also say one thing. And so this is great and all, Opportunity Zone benefits, but if the project doesn't work, you're not going to pay a tax on a loss. You're not going to take any benefit from a loser, right? So what you need to do is find a fund that's going to be successful irregardless of these benefits, because these benefits is just the icing on the cake. You got to look for a good piece of cake. This is the icing.
Yeah, we tell that to all of our potential investors is that, we're structured very similar to a traditional real estate equity fund that's focused on ground up development. And the tax benefits, as you mentioned, they're really once in a lifetime. They're this new program
once in a generation
that is now completely finalized, crystal clear. We know how it works, but it's about the projects. If there's no profits at the end of 10 years, what's the real point of the program?
Right.
Right. So just like you said, I love icing on the cake. I think that's a fantastic way to characterize the tax benefits associated. All right, now to the kind of, I guess,
nuts and bolts. Okay, so we don't have time to go over all of the nuance and the benefits that came about from the final regs, but we are going to talk about 3 of them.
Yeah,
three significant ones.
Yeah, and let me also say, the first round of regs that came out, we think that got 50% of the way to clarity. The April regulations that came out, I'm going to say got us 90% of the way there. The December regulations were 100% of the way there. And it came with some additional,
it came with benefits.
Yeah, some like little bonuses, little diamonds in the rough that we want to point out and talk about today.
Great. So the first one we want to talk about is the 1231 gain. Okay, what's 1231? Well, 1231 is property. So section 1231 in the code, property, is income producing property. So just think of an apartment building. If you have an apartment building, you're making money off that. And if you sold it, let's say you sold it at a profit, that's a capital gain. So you can invest that. However, prior to the final regs, the rule is that you had to wait till the end of the year. So let me just give you a basic example. Say in January 4th, 2018, you sold your apartment building for $1 million of gain. So prior to the final regs, the final rules, you would have to wait till 12/31/19. So yeah, January 6th, 12/31/18. So you'd have to wait till the end of the year in order to invest that gain into an opportunity fund. Now, when the final regs came out, they gave you the ability to immediately invest that 12/31 gain, that sale, the apartment building. Also, what they did is they said you don't need to net with 12/31 losses. So how 12/31 works, it's sort of a chameleon. I know I'm kind of getting into the weeds.
That's what we want to do.
So basically what you normally do is you take your 12/31 gains, your 12/31 losses, and that net, if it's a net gain, then it's taxed at capital rates. If it's a loss, then it's treated as an ordinary loss. So it's the best of both worlds there. But what the final regs did is they said you can take that gain right off the top and invest that gain in an opportunity fund. And then if you have any losses, take all of those losses and take them as ordinary losses. I mean, it's huge.
It's a double benefit.
Absolutely.
Mm-hmm.
So that was one of the biggest benefits.
And I thought 12/31 was always kind of fun. We've been talking about this all year long. Every time I went to an accounting conference, they said, "Oh, well, there's the issue with the 12/31 gains." And of course, that issue wouldn't be solved until 12/31. So, help me remember the name of the code. But thank you for explaining that to us. So just so we all know that we're able to really get that double benefit of being able to utilize the profits as capital gains and the losses as ordinary income, which are taxed differently. And of course,
higher rates with ordinary income.
You get the best of both worlds.
You get the best of both worlds. Mm-hmm. So that was a real gift. Okay. And so also prior to the final regs, specific to 12/31 gains, you were kind of, you were limited. So your clock. So stepping back, so when you decide to take advantage of this program, when you want to take advantage of an opportunity fund like Urban Catalyst, so you would sell your stock, and then you have 180 days from that sale to identify and invest. So for 12/31 gains, prior to the final regs, you would have to wait till 12/31, the end of the year, to start that clock. Even if you knew back in January that you sold that apartment building at $1 million gain, you would still have to wait till 12/31 for that netting process. But now, thanks to the final regs, you don't have to do that. So you can start your clock at the time of the sale, so in January, or you can still wait at 12/31, start your clock then, or even, and this is the best part, is you can start the clock at March 15th, at the unextended due date of the partnership's return.
So let me see if I get this straight.
Yeah.
Okay. So, and this is for the sale of a business, right? Of
Correct.
3 types of capital gains.
Right.
All right. So, prior to the December guidelines coming out, it was
12/31, that's when the clock started.
yeah. So you had 180 days to invest in a qualified opportunity zone fund if you had the sale of a business.
Right.
And you also had, it's kind of like having a second bite at the apple. From January 1st, you had 180 days. I know that at Urban Catalyst, we saw a spike in investment into our fund on June 28th, or the couple of days
Right.
leading up to it, specifically because of this reason. People are realizing that they still had time, but only a couple of days left.
Right.
Now, what you're saying is the December guidelines made it even more clear, gave you almost like a third bite at the apple,
That's
which
right.
is it can be 180 days from the date that you sold or you had your capital gains event, 180 days from the end of the calendar year, or 180 days from March 15th.
That's right. They gave you 75 additional days about, which is very nice.
Why did they do that?
Well, it's because Eric, as you know, when you receive what's called a K1, it normally doesn't come January 1st, right? At the beginning of the year. It takes a while for accountants to fill out the forms, get the information, and you don't typically get those forms until later in the year. So the IRS, very practically said that, okay, well, let's start the clock then at the latest from March 15th, which is the unextended due date. So that's the original due date, right, of a partnership. You have to get your returns in by March 15th. Most partnerships and entities will file for an extension, which gives you 6 additional months. Because partners and investors don't get that K1 till later in the year, it made more sense to start the clock later and give the investor.
This is a great extension for those folks that have sold a business and that is their capital gains event. I know that we had several investors. I can think of 2 different folks that ran insurance companies that sold portions of their insurance company. They had a capital gains event, and then they waited. That was early in 2018,
right? And
they waited until May of 2019 to invest because it gave them more time. But now they'd be able to really sort out exactly what that capital gains event would be.
That's right.
And if they had other capital gains events from other sales of businesses they might not have known about, smaller interests and other types of ventures.
They could pool those in. And yeah, absolutely. So this is another gift that the IRS gave us with the final regs in December.
So now we've talked about, when we talked about the 1231, that was a sale of properties capital gains event. This one is a bonus for people that have sold a business. And now we're going to talk about one that really is for everybody.
That's right. So this is a significant gift. This is
my personal favorite.
This is Eric's favorite. I didn't have this yesterday, so he told me I need to include this, which it makes sense. So zero depreciation recapture. Okay, so what's depreciation recapture? So you have property, and if you benefit from an expense that's called depreciation, general IRS rules say that once you sell that property, you have to pay back the benefit of that depreciation. Your house, what is it, 27 years now over time to get it depreciate?
Yeah, everybody that owns a house, on your taxes every year, you depreciate the structure. So say you buy your house for like 1.5 million and 500,000 of that is the value of the structure. You get to depreciate that over 27 and a half years. Now, of course, it changes by asset class, especially after the Tax Cuts and Jobs Act. Some of them have been pretty accelerated, but that's a good one to use as an example.
Right. So what the final regs did, though, is that these assets in a qualified opportunity fund, when Urban Catalyst exits, all of that depreciation does not come to roost. It doesn't. So you don't have to pay tax on that depreciation recapture. I mean, it's huge.
And this is, when I was showing the timeline slide that showed that we had this income in the second half of the fund, and it said tax-free. How is that income tax-free? It's because it's offset by the depreciation that we're taking on all of these buildings. In fact, we're planning on having more depreciation than income in those years. And that depreciation can be carried forward forever and be used to offset like-kind income. So say somebody owns some other type of real estate somewhere out there. They can use that forever to offset that, which is great. And then at the end of the fund, when we sell all of our projects, we don't have to pay it back. This is one of the big problems that people have when they do 1031s is they've depreciated the asset all the way down to zero. Now they don't know what to do.
Right. And thanks for bringing up 1031 because Some people get confused with opportunity zones and 1031 or which one's better. So opportunity zones, section 1400Z-2, the benefits that come from that code section, in my opinion, are better than section 1031, is because you can take cash off the table when you sell that investment. So when you sell your $1 million of Apple stock, you can take half of it, right? You could take $500,000 of yours and then invest the other $500,000. Why is that important? Well, if you want to set aside money for taxes, not all of the states tax the same way. Not all of the states have conformed, unfortunately, to the Opportunity Zone program. So you might want to take some cash off the table. Whereas 1031, you have to transfer all of it to another asset.
Yeah, and I mean, the biggest difference is 1031s are only for the sale of real estate. And the sale of stock or the sale of a business, they don't have any way to defer taxes or to get these types of tax benefits.
That's right.
And let's just say opportunity zones have more flexibility because most opportunity zone funds like Urban Catalyst, we do ground up development, different risk profile than if you were going out to do a 1031 and buying existing assets. In general, opportunity zone funds have higher returns than typical 1031s, at least here in California, I can say that. Maybe if you're buying property in other states across the country, that might be different, but we're generalizing here. And, the 1031 program we've had, I would say, we've had maybe 15% of our investors have come in through the sale of real estate. Mm-hmm. And a lot of them forego doing a 1031 to invest directly into an opportunity zone fund.
Okay, SEC accredited investors. So what is an SEC accredited investor?
And why is this important to people looking to invest in opportunity zone funds?
Okay, so not all funds will just allow anyone to invest. Urban Catalyst accepts only accredited investors as defined by the SEC, and that's basically someone who is knowledgeable, sophisticated in the world of finance. And there are some specific definitions. One is you have to have made $200,000, $300,000 joint over the last 2 years and expect to make that same amount of money in the current year. That would automatically grant you as an accredited investor, and then you can invest in Urban Catalyst. But there is an expansion to that definition where holders of professional licenses can also meet that definition. I think the reason why we have this here is it's specific to Urban Catalyst. And
there's different levels of accreditation depending on what type of fund is out there. And maybe you could say, why did the SEC, why do they have these different levels of accreditation? And what's the whole point of being an accredited investor? Why is it important?
Well, it's important because you need to know what you're doing, right? So in other words, you can't just go to anybody that is not sophisticated and take that person's money. So it's sort of a protection.
Yeah, no, I mean, that's the way I look at it too. I look at it, it's a built-in protection. You want to make sure that the people investing in funds have the financial wherewithal to be able to invest in funds. So it's a good thing. It's the government protecting the consumer, which is, what we want to see here in this world. And so here at Urban Catalyst specifically, we're very strict about this process and how it works.
In other words, you can't just go door to door saying, hey, you want to invest in Urban Catalyst. You could if they're accredited investors.
You could, but then you'd have to do the accreditation process. And we do that in two ways. The first is we use verifyinvestor.com, where they're a third-party service where we are happy to pay for. Investors do a verification process with them, and eventually we'll get a letter from Verify Investor saying you are accredited. The other way to do it, and this is probably more typical, is that folks looking to invest in Urban Catalyst, they get a letter from their accountant or their attorneys that is how
signs off.
Yeah, signs off and says they are accredited because they know.
Yes.
And that's fiduciary responsibility. So that works as well. And, it's just important overall, like I said, dotting our I's and crossing our T's. We want to make sure that our investors are protected and that we're meeting all of the rules associated with the SEC.
Absolutely, because you have to get everything right in this program to really make it all work. And Urban Catalyst has done that. They have really spared no expense up front. They hired me. So
I'm very happy to say that Nick and his work have been extremely valuable here at Urban Catalyst. They're a really great firm to have as a part of our program.
Thanks, Eric. Okay, so let's get into the form. So how is the IRS going to know that you've taken advantage of this program? How is the IRS going to know that you have a gain that you're going to defer for the next 6 years?
And Nick, I'm really glad you're going to go over this because we've talked to hundreds and hundreds of investors over the last year, and this is something that they all want to know. They want to know, how is it that the IRS knows exactly what's going on, and what are the specifics of what forms we fill out, what do those forms look like, and how does it all work?
Right. Well, it starts with Form 8949. So let's just use a basic example here. So since we're in Silicon Valley, let's say you have 3,000 shares of Apple stock. And this is, I'm not sure if everybody can see this. Hopefully you can, but you'll also see how simple this form is. So basically you put your name down, your social security number. And also I wanted to show that not just long-term gains can be invested, but short-term gains as well. So on this page, this is the first page of 8949, you would say, okay, what property have you sold? So in this example, 3,000 shares of Apple stock, you sold it on May 31st, 19, you acquired it, sorry, May 31st, and then you sold it at the end of the year. So you just say, okay, well, what did you get? $885,000 at 12/31. The cost basis was $525. You have a short-term capital gain of $360,000. So now, how do you tell the IRS that, hey, I'm taking that $360,000, I'm not paying tax on it this year. Instead, I'm going to invest in a qualified opportunity fund. On the next line, you would put Urban Catalyst EIN, and then you would put the date that you entered that investment. So in this example, it's just the end of the year. And you would put code Z in column F, and you would just do how much of the investment that you invested of that $360,000. So this is an example where all of the investment went into Urban Catalyst, but you could, as I was saying, you take money off the table. So you could invest $200,000. So anyway, it sums down to the bottom, and at the end of the day, you're going to have $0 showing up on your tax, on your 1040 you're paying tax on. Mm-hmm. This is step one.
Yeah, and what we do from our side here at Urban Catalyst is we provide, when an investor invests into the fund, we provide them with a letter that confirms their investment, and that letter has our name, date, the amount invested, our EIN number, and our address, so that you're able to fill out this form, or your tax professional is able to fill out this form appropriately.
Right. So that's Form 8949. Another form that the investor will have to prepare and file with his or her tax return is a Form 8997, which is basically telling the IRS, and the IRS wants to get data too. Like, they want to see how successful this program is. And so one of the forms that they're going to be utilizing for statistics is Form 8997. So using our same example, you would take Form 8997, just fill out Part 2, because at the Part 1 is the investment total QOF, or qualified opportunity for investment holdings, at the beginning of the tax year was 0. So what did you do? What did you invest? So again, you would use the EIN of Urban Catalyst, assume of the example, the date that you acquire that investment, the description, so 36,000 units or shares of Urban Catalyst, and the amount of whether it's a short-term or long-term. So in this example, it's the short-term, $360,000. That's it. That's all you need to do on that form. And then Part 4.
Now, Nick, question for you. This is something that, is this something that everybody's accountant is going to be able to fill out?
Well, they should be able to, but you know, if they have any questions, by all means, I will certainly help that.
Yeah, I will say, I guess accountants, you know, they're supposed to be able to fill out all of your taxes. I'm sure they've studied up on this. They're probably not all experts like you. And of course, thank you for offering your services. If anyone wants to call Nick and ask him questions about how this type of investment works on your taxes, we can always make Nick available for that.
I'll send out separate engagement letters. Okay. And we have a slide here for Form K1 because, you know, as we're talking about Section 1231 gains, this is where you would get that information. Also, this is a form that Urban Catalyst is going to be, you know, completing and sending out to all their investors. So
cool.
How are we doing on time?
We're doing great.
Okay.
I'm going to talk a little bit about San Jose, and then we're going to open it up to Q&A here in about 5 minutes.
Okay.
Of course, anybody is free to ask questions, and I encourage it. You can ask your questions in the Q&A section of this webinar, and they show up on our screen, and we'll read them to you and answer them in real time. So first, I just want to talk a little bit about, you know, downtown San Jose and how it received the qualified opportunity zone status that it did. I mentioned the Tax Cuts and Jobs Act of 2017 was how the Opportunity Zone program was created. What the federal government did is they said, here's what qualifies. They designated census tracts as the areas that qualify, and they said that they're lower income census tracts. But after they did that, they thought that the states should really select the actual census tracts that would become opportunity zones, and they allowed the states to choose 25% of the eligible tracts. In April of 2018, Jerry Brown selected California's census tracts. San Jose was fortunate enough to receive 11 zones. And of those census tracts, 4 of them are in the downtown area, as you can see circled on this slide. You know, we talked about how Urban Catalyst has 7 projects in the downtown and how really it's all about the projects that matter. You know, the tax benefits, fantastic, once in a lifetime, but you have to have profits from those projects to make sure you can get, you know, the significant tax benefits that you can see. And I'm going to talk really briefly about our projects. Our 7 projects, we have 2 office projects, we have 2 multifamily projects, we have a student housing high-rise, we have a senior living facility, which is assisted living and memory care, and we have extended stay business hotel. That's that Marriott Town Place Suites called Keystone there. Overall, you know, this is a very diverse portfolio of projects. And that's
fantastic. Yeah, that's how you organize a good qualified opportunity fund. You want to have a well-diversified multi-asset fund for obvious reasons. Honestly, I mean, so you guys made the Forbes top 20 opportunity zones back in December, right?
Mm-hmm, that's correct.
So this is one of the reasons. I mean, you guys have done your work very well.
Well, thank you. And you know, we work hard to do this. We've been doing this our whole careers, and really, this is you know, this is something we're very excited about, and we really like the projects that we have. It's nice to know when you're looking at opportunity zone funds that they actually have projects. So we have these 7 projects. Now we're out raising money to fund these projects. I'll show you where these are specifically. So this is downtown San Jose. The black line represents the opportunity zone. So inside that black line, you can see Diridon Station is over there to the left. That is the major train station, largest multimodal hub on the West Coast. You can say it's really the equivalent of Grand Central Station here in San Jose. Google, you know, briefly touch on them. They've recently purchased $450 million worth of property, over 80 acres in the Diridon Station area. At build out, they're planning 7.5 million square feet of office and 5,500 residential units. That'll be their largest campus on earth when complete. In the downtown here, you can see these 7 blue areas. These are the 7 projects that Urban Catalyst has.
All in the zone.
All in the zone. And of these, 6 of them are ground up development and 1 is a large renovation project. And really that's to meet the rule of substantial improvement for opportunity zones. So now I'm going to open it up to questions. So questions are rolling in here. Let us read through a couple here and see what we can do. All right. Let's see. First question. We need to be clear in the definition of selling stock, because selling RSUs is also formally selling stock, but it is not capital gain.
Well, yeah, as you get an RSU, that's absolutely right. I mean, it's ordinary income. But if you hold on to those stock units and you sell it later, then that is a capital gain.
Gotcha. So maybe we should just expand upon that a little bit and talk about, because a lot of our, I'm sure a lot of our listeners, they are people that have the sale of stock as their capital gains event.
Sure.
We see a lot of that here in Silicon Valley. Maybe we could talk about, if you're an employee of a tech company and you have stock options or
ESPP, yeah. So
you've been acquired, tell us how that works.
So let's say you're working, you've been at a company, it's done really well. You've participated in an employee stock purchase program or have ISOs and unqualified stock options, whatever. So let's start one by one. So ESPP. So you've taken money off the top, you've invested in the company's stock. Now that stock has appreciated. If you have not sold that stock and that stock is in the money, then you have an eligible gain that can be invested in a fund like Urban Catalyst. That would be your starting point. You would sell it, and then through the examples that we discussed, you would have 180 days from the time you sold that appreciated stock to invest in a qualified opportunity fund, such as Urban Catalyst. Does that make sense?
Mm-hmm, it does. We have another question. Is there a minimum amount of investment to invest in an OZ fund? So in general, all opportunity zone funds are different and have different minimum thresholds. Urban Catalyst, our minimum investment is $250,000. Next question, how does the IRS calculate substantial improvement?
That's a very good question. So, and the recent final, and the final regs gave another benefit for this test, the substantial improvement test.
And let me just back up a little bit. So a lot of rules for opportunity zone funds to qualify as opportunity zone funds. And one of those rules is called substantial improvement. It's a specific test, and that's what we're going to talk about.
Right. So if you buy property that isn't originally used property, so you buy a building that's been around, that's taken advantage of depreciation, what the IRS is, or what the rules are, is that you have to substantially improve that property. And how you do that is you have to invest the same amount of money that you purchased the building. So you have to double the fair market value of that property.
Yeah, of the structure.
Of the structure. So for example, you say you buy a building for $250,000. It's in rough shape, but it's not originally used property. You have to invest another $250,000. But what the final regs did, though, so let me just give you a quick example. Say you bought a hotel that's been in rough shape for $250,000. Now, you have to spend another $250,000 within 30 months. That's another one of the rules for the timing of substantial improvement. You can buy other property that goes into the hotel that would count towards that. So it's not just renovations. You could buy restaurant equipment, bed linens. That would all count towards your substantial improvement investment.
So, and let me just talk very briefly about how Urban Catalyst does that. And by the way, that December guideline, huge benefit to us. I mentioned we have 7 projects, and one of them is a ground up development. One of them is a large renovation. So we bought a movie theater called the Camera 12 Cinema. We're doing a project called Paseo. We're turning it into an office. Because of those December guidelines, that building had been vacant for over 3 years. And so that building, it was substantially improved when we bought it because of the December regs. So that was great.
Yeah.
When we buy other properties, we go out and of course we do an appraisal when we purchase the property, and that appraisal will say, here's how much the structures are worth, here's how much the land is worth. And what we have to do is we have to put money into the project on a 1-to-1 basis equal to the value of the structures that are built currently on the land. little side note for our projects at Urban Catalyst is all 6 of our projects that fit into that category, we will substantially improve those projects prior to starting construction.
Wow.
Because the cost of construction documentation and city fees count towards substantial improvement.
That's right. And professional fees.
So
So the more you pay me to...
Fantastic sidebar. Next question. When is the deadline to invest in Urban Catalyst? Our deadline to invest in Urban Catalyst Opportunity Zone Fund 1 is December 30th, 2020. Next question. Can Opportunity Zone funds be used to pay employees managing the fund? The answer to that is no. That came out in the original clarification of the first round that the fund cannot be used to pay employees. So that's a good one. Let's see.
What is the expected IRR after 10 years?
So for the purposes of this discussion, we're not going to do any forward-looking statements. That's part of the FINRA guidelines. So yes, I'm not going to answer that question on today's webinar. Right. Yes, we have fantastic returns. You can come and talk to me about it. Let's see here. Is there any time limit to complete the development? Yeah, so when we were talking about substantial improvements, we have 31 months, or sorry, 30 months. We have 30 months to complete those improvements in the development. Let us see here. Finally, we'll take this as our last question. This is let's see here. I'll take one more question. So we've got to read through. We have a significant number of questions here.
Yeah, this is great.
We just want to make sure we answer a good one as our last one. Okay, last question. It says, how long, if we invest in Urban Catalyst, how long is our investment locked up before we're able to get a return? So Urban Catalyst, I've mentioned we're structured a lot like a traditional real estate equity fund that does ground up development. One of the major differences, however, is that typical ground up real estate development equity funds, they're looking at 5 to 7 year returns. Their business plan typically is to buy property, develop that property, build the buildings, lease up the buildings, stabilize it, and then sell, because that's how they maximize their internal rate of return. Because of the 10-year timeline associated with the tax-free profits, we hold the projects for an additional, say, 5 to 7 years before we sell them. So it makes it a little bit different. But when does the money come out? The first money comes out starting 2 years after the final investment. So our first money, it'll be a refinance event from our Paseo project, which is our renovation project, 2 years. So that'll be in 2023.
So 2023 is when you get.
That'll be the first investments coming back. And we plan on being able to return a significant portion of our investors' initial investment within the first 5 years of our fund. And then throughout the second 5 years, we do have cash flowing assets. So we'll be distributing cash through the 3 years, 5 through 10. But of course, the big win is when we sell all of the projects, and that's after 10 years. And that's how to get the tax-free profits. Our overall goal is to maximize the returns to our investors and to really maximize their tax benefits.
Yeah, that's great.
All right, well, thank you everybody for joining us today on our Expert Series webinar with Nick Gibbons, CPA from Armanino. It's been a fantastic experience. Thank you for all of your questions. I look forward to talking with you next time. And of course, you can always learn more about Urban Catalyst at urbancatalyst.com and about Armanino. Give yourself a plug, my friend.
And you can reach out to me via LinkedIn, of course, Google Armanino. We've got a great website. Anyway, thank you all for attending.
All right, with that, we're going to end the webinar. Thank you very much.